Hello, everyone. Good morning, good afternoon, and good evening, depending on where you are. First of all, I would like to welcome all of you to our Asia Clean Energy Forum 2022, and then also to our special session on this track 4 financing NDC action. I hope that you have also joined our earlier session on this under this track also. My name is Jeevan Acharya. I'm the Principal Energy Specialist in ADB's South Asia Energy Division, and I'm also active member, I would say, in ADB's climate change area, and have been focusing and also developing various projects and programs in various countries as well. So I will be your moderator for the session today. I mean, for this group, I think I don't need to mention how important it is to implement these nationally determined contribution NDCs for all these countries. We are also, we can see that there is a encouraging commitment from these countries in terms of their actions. But what is important is that those actions will have to be implemented. So that we'll get the results. And then we are running out of time, and every country and everybody is under pressure to deliver that one quickly. And of course, even if you have a very good plan, but it requires so many things to fall in place before such activities can be implemented. I mean, there it would require your capacity. Of course, your policies and regulations should be in place. You also need capacity of the people and so on. But financing is always, of course, very important part of that one. So as you know, this track, we are looking at how to finance these NDC actions. And of course, governments from the public sector side of it, they can do whatever they can. And then the public sector financing from institutions like ADB, World Bank, and others can also contribute in that effort. But no matter how much money we put in, that will still be not enough. So this is where bringing in private sector investment becomes very, very important part of it. But having said that, we always talk about bringing private sector. It's all easy to say, but private sector do have their own concerns and constraints as well. First of all, why would any private sector invest in a project if that is not attractive for them, especially from the returns point of view also? And then sometimes the regulations and rules of policies are not very clear, so that's why they take these things as a very risky business there, even if they can organize such financing and technology needed for this country. So this is where we need to all work together to create that environment where private sector can come in and then bring that necessary investment into this NDC related activities. So what we are doing today in our 90-minute session is that we have 3 speakers, and then I will introduce them, and then they will make a short presentation. And after that, we have a kind of panel discussion where I will be asking them very tough questions. And then, but from all the participants, please kindly, if you have any questions and thoughts, please put that in your chat box, and then I will pass on to our speakers during our panel discussion and Q&A later on. Without further ado, so now let me first of all introduce the first speaker, Randy Christiansen. She is from the UNESCAP. And she works there in the energy division of UNESCAP, and then she's looking at mostly on the broad connectivity issues and this transmission connectivity in the Asia Pacific region. And then also before joining UNESCAP, she was also working with IEA and the renewable integration and secure electricity unit there. So she had a lot of experience while she was with IEA in the Southeast Asia, China, and India related matters. It has both power trade and power system flexibility as well. And she was also working with a Danish transmission company before, so she has also a lot of European experience and background on this one as well. So now she holds a master's degree in economics from Aalborg University. So Randy, over to you for your presentation, please.
Thank you very much, Johan. And while I'm sharing my screen, I just want to thank ADB for yet again putting on another great ACEF event. So let me know if you can't share my screen. Otherwise, I'll just assume that you...
Yeah, we can see it. Please go ahead.
Thank you. So what I'm talking about today is bringing in private finance in transmission development. I want to start with a figure that shows why I'm talking about this. So this is an IEA figure showing different types of developments. And if you look at the far right graph, you will see if we're to reach net zero emissions, then investments in renewable energy, but also networks have to increase significantly. If you actually also look at the bar just behind that, the sustainable development scenario, it also shows that to reach the SDGs in 2030, we also really need to scale up investment compared to where we are today. So that's why this is a really, really important topic, because not only do we have to talk about scaling up renewables generation, but the grids as well. So in the Asia Pacific context, I wanted to give a little bit of background as to why the UN is talking about this. So the UN Energy Division has a roadmap for power system connectivity, which was endorsed by the member states in 2021. This roadmap sets out a multitude of strategies to achieve power sector connectivity, and strategy 7 is actually mobilizing finance. So if we look at the Asia Pacific context, most of the grids are financed by governments. But in order to reach the needed investments levels that I showed before, all sources of finance must be unlocked. There are some examples of private finance in grids in the region, but it must be brought more to attention on how to solve any barriers or what options there actually are, because I think this is a topic that is under discussed. So there are, according to us, we've developed a working paper on this topic, and I'm not going to go through this figure in detail. It's just to say we have 6 main models for bringing in public or private finance into grids. And as you'll see in the far right column, we have examples of these models being used across the world. Some of them are used in Asia Pacific, as I mentioned. For example, the independent power transmission model has been used in India, and the whole of grid concession model has been used in the Philippines. So to show that this is just these are not models that are just relevant for example, Europe or the US, they're also relevant for our region. I'm going to dive into 2 of the models just in the interest of time. If we start with independent power transmission, it's similar to what we know from the generation sector, where we have IPP, so independent power producers. This is a model where you have a single line or a bundle, like a small bundle of lines that could be developed, owned, operated by private investors. The really great thing about this model is that it can be piloted alongside a more traditional setup where you have a utility, a government-owned utility that is developing the grids as well. The thing, though, is that the projects needs to be large enough to justify the transaction costs, both on the developer side, but also on the government side. Because obviously you need to run tenders, there needs to be some capacity and some learning in the government as how to do that. But the private sector also needs to establish their value chains and general business in the country to do this. And you're not going to do this for a small project. So they really need to be relatively substantial. There's also a possibility to either do early stage or late stage tenders, which depends on how far you kind of develop the project before you tender it out. When you're talking about doing some learning, potentially piloting the project, it might be worthwhile looking at late stage tenders, because then the government can design the project in quite a lot of detail. As I mentioned before, this has proven successful in India. And I also think that the important fact about this being successful in India is that if you take the power sector context of India into account, you have issues with the financial viability of the discoms in India. But this model has actually brought private investment to the country, still given this context. So again, as with when you look at the generation side, IPPs, the capacity of the governments to actually run these tenders is key, and that will, the transparency in the process will really drive the appetite for private sector in participating in the tenders. Then we also, the other model I wanted to speak about is a merchant line. This is a line that is fully initiated by the private sector, but this kind of line really requires quite a sophisticated market setup where the investor can collect price differences. For example, they need to collect tariffs that are not kind of regulated. So it typically requires price differences between two areas. This is why this model is typically used between countries, because not all countries have price differences within your country. The UK is an obvious example of application of this model. The UK has also combined this model with a floor and cap scheme, where the government goes in and guarantees a certain minimum revenue by having the investor give up a revenue over a certain threshold. This is a way that the private sector can still really initiate and drive forward the investment, but the government can go in and do some revenue stabilization and security and incentivize the investment. As I said before, this is typically relevant for more mature power markets, so not something I necessarily see widely used in the Asia-Pacific region, but I still think it's worthwhile to mention that there are grids that are being totally driven by the private sector. So, what are the considerations for the governments? You really need the appropriate legislation. I think it's important what Johan said in the introduction, that in order to get private sector to engage in these types of markets, you need transparent and stable legislation. You need types of institutions that actually make sense. So let's say you have a situation where an incumbent utility and a private investor have to compete for a tender, then you need to make sure that there's no unfair advantage for any of the parties. You need a power sector that is relatively stable so that you don't consistently change rules, change legislation, change policies, because this will scare away private sector. Obviously, looking into this, the state of the government finances is an important driver. It can both drive that you engage in opening up the grid development to private finance, but it also needs to be a consideration in terms of how do you make sure that the private investor is comfortable with getting their revenue. So also just a last important point, because this is still financing NDCs. Grids by themselves do not guarantee sustainable development. They have to be combined with holistic renewable deployment and generally holistic power sector development plans. So I'm not sitting here just pushing grids for grids. I'm pushing grids and private finance in grids to facilitate the deployment of renewable energy. So what is next from here? Investment in the power sector needs to increase. There's just no question about that, and it needs to be across the power sector. There's no exception. So we have released a working paper. It says policy brief, but it's actually a working paper at the UNSCAP website. So if you want to look more about what these models are, you can go there. Also, UNSCAP leads the Asia Pacific Working Group under a COP initiative that was launched in last year, a COP, which is called the Green Grids Initiative, One World, One Sun, One World, One Grid. It was launched by India and the UK, and it aims at accelerating grid development linked to renewables deployment and sustainable development. And we're really happy to say that ADB is also a really, really important partner in this working group. That being said, SCAP is keen to partner with any stakeholders who want to advance private participation in grids. And with that, I look forward to our discussion later. Thank you so much.
Thank you so much, Randy, for taking us through this work that you have done and then laying the important aspects of this, bringing private sector for this transmission line. And I know that you made a very good point that transmission line for the grid, for the sake of grid, is not what we all are looking for. I mean, grid is important. So, but there are for generation and also distribution part of it becomes also very, very important. So my next speaker is. John Byrne. I hope that I pronounced it correctly. So he's the vice chair of research and senior research fellow at Asian Development Bank Institute. He has been appointed as a vice chair just recently, but has been working there for some time. And he has also led various working papers in this topic through ADBI and also in his previous job, I think it was KPMG and others. So he has a lot of experience in developing this kind of research and then also shared that to the wider group there. So John, over to you, please.
Thank you very much, Johan. So it's a pleasure to present here today. I would like to talk about the issue of how we can unlock private investment in renewable energy. This is essentially based on some recent empirical work with co-authors on this issue for a global sample of economies, but with a focus on Asia. To set some context, the charts here show that, in spite of the recent pandemic, we have seen progress towards energy transition. But I think in the current climate, as everybody knows, it's crucial to leverage private investment, given the fiscal constraints that have been imposed by recent developments. The remainder of the presentation will be structured as follows. So I'll talk a little bit about the background and the empirical methodology to be followed, some of the results, and I really want to focus today on the policy takeaways, which is of key interest in the context of this session. So the background to the study was to really look at the barriers to investment to renewable energy and to really try to understand how government action and government policies can leverage greater levels of private investment in renewable energy. Of course, there are impediments related to high risks relative to long payback periods and returns. And I think these have already been mentioned earlier, and I will go a little bit deeper into those issues as well. Initial high capital costs are also a factor that private investors face, which may be an impediment to their willingness to invest, and the government can have a role there to play through various different types of policies. But the purpose of this analysis is really to understand which different types of financing can be most affected by different types of policies. And the policies that we focus on are government expenditure and R&D as a leverage vehicle for private investment, feed-in tariffs, which of course have been very effective in the past, and there are some differences in relation to their effectiveness across different types of private sector investment, and as well as that, tax incentives can be important as well. So across those three key government interventions, we look at how private investment has been leveraged across different types of financing. So as I say at the bottom there, we distinguish across different sources of private investment. Just to provide a little bit more background, there's essentially a financing continuum in place for renewable energy, whereby the continuum runs from technology research, so early stage right up to rollout, and there are different levels of risk involved with each of these stages, of course. And with these different types of risk profiles, there's a different form of financing that becomes more suited or tends to be more attracted to that type of stage of technology development. So government and corporates tend to be more involved at the beginning when risks are high, whereas at the rollout phase, we see more evidence for debt markets and public equity markets having some role to play on the private sector side. Some definitions of the asset classes that we look at. So we look at 4 different types of private investment, namely venture capital, asset finance, public markets, and corporate R&D. As I said, our focus is to look at how different government policies aimed at enhancing private sector involvement in renewable energy are differentiated across these different financing categories. For the sake of time, I will go a little bit quicker through some of these background slides, but it's essentially to show that in this case, asset finance has been a dominant force. This is not to say that it should be only considered as the dominant force going forward. There may be opportunities missed in tapping into some other sources of financing, and our empirical findings indeed show that to be the case. There are some differences across countries, but essentially it follows the overall picture that asset finance is dominant. And also the same goes for a breakdown of different types of technologies as well. So in terms of the data, as I said, our main interest is in looking at explaining private sector finance in asset finance, corporate R&D, public markets, and venture capital. We also control for the usual factors, but our key interest is on understanding the role of government R&D, feed-in tariffs, and tax incentives in affecting these private sector investment levels. I'll just skip this. These are our main results, but let me turn to the graphical illustration of the results, which is as follows. And what we can see is that for the main government policies aimed at attracting private sector investment, we can see a very large role for tax incentives. Tax incentives are, of course, very important in stimulating private sector investment, and this should be continued, but there are important differences across types of finance. For example, corporate R&D can have problematic effects when tax incentives are brought into play. And this is because there are some discrepancies as regards import duties, and these can actually lead to a disincentive to private investment. We also see a strong role for feed-in tariffs, and there are differences across countries related to duration of these effects. But there's a clear illustration of these types of policies having a strong impact on incentivizing private sector investment. Government R&D is also an important factor, but we see that the marginal effect of this is somewhat less than tax and feed-in tariffs. So there are clear lessons to be learned there, particularly in the case of Asia relative to the rest of the world. So the main conclusions from the analysis would be that, as I said, government R&D has a positive impact on private investment from asset finance and corporate R&D, but it's not the most important driver in terms of magnitude. We see that the strongest magnitude of effect is coming from feed-in tariffs as well as tax incentives. Some care must be taken as regards tax incentives. They can have some counteracting effects, in particular types of private sector investment financing. So what lessons can we take away from this analysis? Well, I think it's clear that not only in relation to renewable energy, but in relation to encouraging private sector investment in any sector, it's important that the environment is such that investors are willing to take some risks, because there is an inherent risk associated with making investment, particularly in renewable energy, whereby there can be very high startup costs, high initial capital expenditures, and very long payback periods and uncertain returns. So it's important to create a climate of a climate for encouraging private sector investment. As we saw, the feed-in tariffs have remained very effective, and more can be done there to make them even more so. And that can include, for example, through altering fiscal incentives, terms of agreement, and tariff prices. Tax incentives, as I said, should be used with caution. And finally, a policy insight would be that countries that have lower regulatory quality may need to offer higher feed-in tariff rates in order to increase the effectiveness for attracting private sector investment. So that would be all from my side. Thank you.
Thank you so much, John, for laying out some of these things which are important for this governments and also private sector. And you also led these different instruments and mechanisms that can be used, and also their pros and cons to some extent as well. So we'll have a further discussion on these aspects later on. But now let me turn on to my third speaker, Marga Manjo. I hope I pronounce it correctly. Marga is an investment director in Sun Funder. And then she will be kind of talking about the case study on structured finance to scale up adoption of decentralized energy and climate solutions. So I think it will be a very interesting topic, and I'm sure she will talk about as a project developer and also a kind of a funder for some of these interesting work there. She has an MBA degree and has a lot of work and experience in kind of various structuring of the various projects there. So Marga, over to you, please.
Thanks, John, and thanks to the ADB for inviting us. And I'd like to thank John actually for laying out what are the different things that we're looking at. How can we what are the different issues that we're looking at as private investors, looking at the renewable energy space. But what I want to shed light on over the next 10 minutes is really looking at beyond feed-in tariffs, your utility scale projects. Let's look at the maybe smaller, more overlooked kind of projects, looking at off-grid electrification, CNI, smaller scale, SME, financing on the renewable energy space. And just as a brief background, Sun Funder, we're a specialized debt funder into climate and decentralized energy startups, or not startups, companies. As you can guess from the name, we finance primarily things that have a solar component, be it solar home systems, mini grids, telco solar projects, and CNI. Over the last 10 years, we've funded over $165 million in loans to primarily African companies working in the off-grid space. We opened an Asian office in August last year, and so we're now actively looking for projects as well in South and Southeast Asia. We've already, seen various versions of this where there's a big need outside of the OECD countries to actually finance renewables. There was an IEA study last year that said we need to increase energy investments in emerging markets by 7 times. So that's a lot of money. Not all of that's going to come from the from the government. And so we're going to need to find blended finance kind of structures to finance SMEs, growth stage companies, and just finding alternative ways of funding both large scale projects and small scale projects. So here, $135 billion is what we're looking at for 2030 on just for off-grid and distributed energy. So at Sun Funder, this isn't all of the subsectors that are in this smaller scale utility scale space, smaller scale, not utility scale, renewable energy sectors. But at Sun Funder, we focus on off-grid solar, mini grids, and agri-solar, CNI, telco solar, and innovation. In this innovation bucket, a lot of things fall under that. There's a lot of nascent business models in e-mobility, storage, energy efficiency. Even agri-solar is a up-and-coming sector in Asia and as well as Africa. And you look at the types of financing needed, there's things that we can take from other sectors and apply to these new kind of business models and smaller business models. So ranging from working capital loans and inventory financing for solar home systems, pay-as-you-go systems, mini grids, procurement, receivable structured financing, especially again, for things that are pay-as-you-go, or lease models for things like solar water pumps, as well as applying project financing structures to, let's say, larger CNI, but not doing it project by project, potentially looking at kind of framework structures so that CNI developers are looking at multiple countries, but still doing, let's say like your sub 20 million kind of ticket sizes, portfolios of smaller CNI projects, and how can we finance those? So if you look at the Asian market, and these are some of the things that we are seeing as some of the issues, finance or the unmet gaps in financing. Particularly, for example, like longer tenors. If you're a CNI developer, smaller scale, you're not getting like the 10-year tenors that your larger peers. For example, in the Philippines, like larger CNI developers would have access to longer term financing from the local banks. But if you're kind of tier B developer, and probably these are the ones who are also looking at your smaller scale CNI in the provinces, like up and coming, like urban areas, they don't have access to that type of financing. On the working capital side, even on the EPC developers, they have a hard time like tapping local bank financing for working capital, especially for procurement, but a lot of that is funded upfront. On the security side, like, can we find like different security packages, not just looking at, say, getting a personal guarantee or getting a land title? What else can we use as security, and like applying lessons from other sectors and using that in the energy space? And you have here overlooked sectors. There's a lot of, for example, interest in like utility scale solar, like larger scale CNI, but microgrids, rural electrification, island electrification, efficiency, e-mobility, like those sectors are still pretty nascent, but not getting as much interest. And developers that are stuck because these are high capex upfront kind of projects, but not a lot of sources of funding. So what I want to do over the next few slides is really look at some examples of like how we've structured finance for some of these sectors in the past. And maybe we can use some of the models that Sunfunder has used in the African context and apply these to some projects in Asia. So the first two projects that I'm showing here are agri-solar projects. So one example that we've done is a loan to Inspira Farms that does solar for cooling or cold storage units. And Inspira has an interesting model where they actually provide leases up to 48 months, for up to 4 years for cold storage facilities. And this is one of those things that we don't have a lot of those models in Asia. And if anything, we have a greater need in the agriculture sector for something like this, where how can we scale up these solutions? So one of the solutions that we've looked at is providing receivables-based financing, where instead of getting a land title from the owners of Inspira Farms, we're looking at taking 50. We're using the receivables from the leases that they're providing to their customers as the collateral for the facilities, and we're debt sizing based on your upcoming receivables. Another example that we've done is a syndicated debt facility. So it's a blended finance structure, bringing in like private investors such as yourselves, as well as DFIs to finance solar water pumping distributors in Africa. And here, where instead of just debt sizing once, we're actually using a very flexible like borrowing based model. So if we provide them with a loan, they increase their inventory, they sell solar water pumps, and as a result of that, their asset base increases, and then we can actually debt size a larger facility. But all of that comes under one structure. So it's a flexible asset borrowing based facility that grows as Sun Culture grows. And it's a model that we can potentially use for like other Asian kind of agri-solar companies, so that they can actually scale their operations and not have to keep looking for funding. Another thing that we're looking at, and particularly in the Southeast Asian context, is framework models for project financing. Instead of financing one project at a time for CNI, if we have, younger CNI developers who have like portfolios, let's say sub 20 million, not very interesting for a local, like your traditional funders or your local banks, but they're the ones who are actually going out and doing the smaller scale, like your factory in a tier B city. And those are overlooked CNI projects, but if you aggregate those, it's actually a sizable opportunity. And so what we're trying to do with CNI clients, and this is the example we have here is Daystar in Nigeria, but it's very applicable in the Asian context as well, is really having a structure wherein if you have standardized types of PPAs, as well as checklists for doing due diligence, you can actually, let's say, instead of providing one project finance facility for $1 million, you can actually do 5 million. You don't need to see the whole pipeline. But if there's a standardized list of requirements, it makes it easy for a CNI developer to actually just draw down on that facility. And it enables them to scale up and not worry about financing, and they can focus on execution and pipeline building. The last example that I have here is mini grid. This is second to the last example. Mini grid financing, and I guess in the Asian context, it's probably more like in the Philippines, Indonesia, Myanmar, more like your island electrification, rural electrification. In Africa, there have been a lot of programs for results-based financing for mini grids, and in Myanmar, they had something like that as well. But perhaps it's something that we could look at for other countries where there's results, what do you call this, like debt available to mini grid developers, but it's only unlocked at the end of construction. So at that point in time, like before COD, construction is funded by the developer. So there's still a need for bridge financing options for them to kind of bridge that gap between construction and COD. And here where a Sun Funder loan for construction is taken out by your RBF facility. But there are examples of that even in the Philippines, for example, where you have like EU and USAID funded projects. This is potentially a model that we can use where private construction financing can be taken out by grants or subsidies and things like that. But what the effect of that is you grow the portfolio of like project of mini grids. You do have developers that are building a track record and are also reaching economies of scale. And that will allow us to potentially look at project finance facilities and go up to, let's say, like 7 to 10 year kind of tenors that match like your mini grid payback periods, which we're not seeing really anywhere yet. But it's something that private investors could look at as the sector gets de-risked and more investors, or I guess like more blended finance facilities de-risk the space for private investors. The last example I have is receivables financing, basically for pay-go models where, for example, this is a working capital facility for Yellow Solar in Malawi, which is a solar home system distributor. But in Asia, we've seen like pay-go models already, for example, for irrigation as well as clean cooking. And the same lessons that you've learned from solar home systems could potentially be applied to some of these like pay-go models for other productive end uses, where a private funder like ourselves can look at collateral based on contract values. So for us, the way we structure this is, let's say 50% of 70% of like inventory purchase is what we finance. And then we take collateral over the expected kind of net present value of the receivables from the pay-go model. So let's say you have solar home systems that pay back in 2 or 3 years, or a clean cooking system that pays back in 48 months. Then we use that as the basis for debt sizing a facility for pay-go systems. So these are some of the examples that we've seen in Africa, potentially like for us at Sun Funder. We're a blended finance like fund manager. We've been funded by DFIs as well as different like foundations. And for us to be able to use that financing to kind of test new models for financing these smaller scale projects, I think is important. It's complementary to what larger financiers are doing on the utility scale, as well as the governments that are what they're doing on the policy side to enable this like renewable energy transition. So yeah, that's the end of my presentation. Yeah, feel free to contact me here if you have any questions and comments.
Good. Thank you, Marga. That's really appreciate you sharing these examples from various places in terms of the projects that you have done in Africa and also in other parts of Asia as well. So really appreciate. So now, now we move on to our panel discussion. So I invite all the three speakers here, and then. And I also encourage our participants who have been watching us this session. If you have any questions and thoughts, please don't hesitate. Just type it in your chat box, and then I will bring in that discussion as we progress. And I have already started receiving some comments and questions already, so which is very good. So in our this panel discussion, what I propose is that let's focus on these three main areas. As I mentioned in my opening remarks, one is on this enabling environment. I mean, we all talk about private sector, but if the countries are not creating or the environment is not good, it will be very difficult for the private sector to come in there. But at the same time, creating this enabling environment is also kind of a very country specific and also, what does that really mean for any country to create that, give that environment to bring in private sector? I mean, in my own experience, I have been also dealing with or discussing with various governments. I mean, they always are trying to, provide that support, provide that clarity for the private sector to come in there. But then, I mean, but at the same time, the private sector keep on saying that, okay, we need this, we need that, we have done this, but we need more, we need more, we need more. So how do we balance these things? Because there are certain inherent risks for it. But at the same time, it is also expected that that these risks are shared. But at the same time, if these risks are not known properly, then the private sector will put that into their pricing. Then it becomes more expensive. Then that doesn't solve the problem either. So how do we kind of manage this very complex situation, where it's easy to say that enabling environment is needed for the private sector, but what does that really mean for the governments? What else do they need to do so that the private sector can come in there? And also, do we have to look at things which are, maybe certain subsectors or certain technologies where the private sector investment can come in? And then there are certain things which are good for the public sector to finance it. And then Randy, you did mention about, this how to bring in private sector for the transmission line also. I mean, you took example of India, where the private sector are also coming in and constructing these transmission lines. And you also took example of UK, where, government will ensure that certain returns will be maintained or guaranteed. But that may apply for certain countries, that may not apply for other countries as well. So what I wanted to do is I wanted to request all three of you to from your perspective of how do we manage, or how do we handle, how do we address this enabling environment to bring in private sector investment into these countries. We need to keep focusing on this, our NDC actions, and of course there are many other sectors which will work very differently. So give us your honest opinion in terms of what does it mean, that enabling environment? And then who needs to do what? Is there a role for private sector to also contribute in that enabling environment, or is it we are looking at only at the governments to do this one? So I will request all three of you to. I'll give you a few minutes to share your thoughts and suggestions, and don't be shy to make a comment which may be a little bit provocating as well. So Brandy, you want to go first?
Sure, thank you. I think enabling environments is a massive topic, and I could speak for days about this, but I want to say one thing is really key, is risk allocation needs to be distributed to the entity who is best at handling the risk. Some risks are best left with the private sector, some are best with the government. So you hear the private sector speaking a lot about intransparency and unpredictability. And I think that's really the role of the governments, to make sure that their policies are clear and they're transparent. Because this is the way, what we're seeing in Asia Pacific in some cases, for example, in Indonesia, you're seeing that the required rate of return for investing in renewables is higher than a lot of other places. And why is this? And this can be really explained by a large factor by some of the enabling environments and the policies that the governments are kind of enforcing or not enforcing or changing. Not to say that Indonesia is not doing a good job at moving forward, but there are differences between countries. And I also think that the contextual difference is really important. I also think that, yes, the private sector needs to be involved. Stakeholder consultation is key when talking about enabling environments, because while the ministries, the regulators have a big role in designing the ecosystem of the power sector, let's say, it's impossible for one person or a small group of people within a ministry or a regulator to understand all the unintended consequences across the sector. So bringing in people who are actually on the ground with the hand on the cooking plate, that are the private investors as well, is really important to understand all the effects that some changes in regulation or policy may have. So I think that kind of transparency. And then the last thing I really, really want to emphasize is data transparency. So in Asia Pacific, I think compared to some other regions of the world, it can be difficult to find data. And understanding what data can be shared without compromising national security, because we also need to realize that the power sector is a topic of national security, and that's okay. But there will be data that can be shared, and also maybe be shared with a lag that actually really increases the private sector's ability to evaluate and be efficient in terms of investment in the power sector. I think that will be kind of my quick overall comment. Thanks.
Thank you, Randy. I may come back to you on some of these points later on also. So now, John, over to you if you want to share some of your thoughts.
Yes, it's a very interesting question. I think that in order to encourage private sector involvement, particularly in renewable energy, there's a need to address the issue of risk and what can be done to reduce this perceived level of risk for private investors. And one way that this can be done, of course, is by providing more information on not only things like carbon pricing at the international level, but also climate policy within the particular country. This can provide more certainty to private investors and encourage them to invest as a result of that. Related to that, I think that more information on regulatory policy is a key issue, as well as lowering barriers to entry. There's some cross-country differences in respect of that issue, which are an impediment to private sector investment. Another issue I would like to mention is that there are differences in the level of private sector involvement depending on the stage of development that economies are at in terms of their adoption of renewable energy. There are different risks associated with different levels of renewable energy adoption, and I think that governments need to really understand that in targeting policies to encourage different types of private sector investors. I think that some of the work that we carried out showed that while tax incentives, for example, are very important for encouraging asset finance-backed private sector investment, there can be negative effects of tax incentives for different types of private sector finance. And this is related to the fact that they can actually disincentivize private sector investment in some cases where there would be, for example, imports of renewable energy technologies, which would obviously discourage renewable energy technology development at the early stages of renewable energy adoption. So I think that this factor should be at the forefront of policy makers' minds when they're trying to target private sector involvement and encourage private sector investment in renewable energy, as well as the other issues I mentioned about reducing the perceived level of risk, which is of course a key factor. Thank you.
Thank you, John. This is there's very good points that you mentioned there. We'll come back again some of these points. Marga, over to you.
Yeah, I think it's probably just echoing what Brandy and John have said already, but it's really this clarity in terms of regulations. I think just like very real examples, for example, in Vietnam with like the feed-in tariffs, where you just have, I guess, unexpected effects, but it's also the feed-in tariff has been taken away, I think like 3 times at this point before it was like meant to end. So in terms of like private sector coming in, you have like developers who put in money up front. They've scrambled to like raise local financing at questionable like interest rates. And you're stuck holding these projects where the regulation has changed, but you're stuck with like curtailed projects. So having those types of like making sure that before, I guess, let's say a new policy is put in place, like there's stakeholder engagement and things like that, where perhaps like the feed-in tariff is not even necessarily needed in like some places, and ensuring that the policies have been put in place actually you've checked with the private sector, like perhaps like if they have access to financing already from like a local bank or something like that, like the prices they're going to be providing, for example, are already actually competitive versus grid. And a feed-in tariff is not necessarily required. So it's really understanding like where are these incentives needed, and where the private sector actually has the know-how already from the past few years from like developing projects that it's not necessarily needed. Like there are a lot of like overlooked sectors, let's say like in the agriculture and like energy space. It's a much needed like focus area, but there's not much talk about like what can we do there. And it's also because it's this like silo mentality between, let's say, agriculture versus energy. We don't think of them as related topics, but they are. And then in terms of like, for example, like upcoming kind of technologies like EVs, we've already seen like Indonesia, Thailand put in incentives for that space. So I think like touching on what John has said about like R&D, is like having these like incentives in place so that your local manufacturing sector can start going into this and investing in that sector is actually needed. So it's a combination of having like very clear policies that won't be taken away and enabling these more kind of nascent business models to develop with the support of the private sector.
Good, thank you. Before I move on to another topic, I wanted to come back one more time on this enabling environment issue. See, when a private sector is let's say that if the government is inviting private sector, if a private sector finds let's say one renewable energy project, whether it's a hydro or solar or anything, then they would certainly need clarity on their policies and things like that. But one of the things that they often ask, and then it's kind of a fair from their side, is about making sure that the land is available, the right of way things are for the transmission line is given or arranged. Maybe the government would be better placed to ensure that those things will not be affected for the private sector. So these are kind of a very fair things for any private sector to ask. And the government may say, yes, okay, this is fine, we'll make it available for you. But then during implementation, then if some issue comes up there, and if anybody goes to the court and so on, then these things drags on and on and on. So neither government is happy, nor the private sector is happy. and then there are certain rules and procedures that everybody will have to follow also, and there are reasons why those rules and procedures are there. So then this risk taking approach is, as Randy also mentioned there, maybe the government may be better to take those risks because they will have the power and the muscles to control some of these things, or can facilitate as well. But because it's with them, then maybe things may not get sorted out quickly also for various reasons as well. So then we're not solving the problem there, right? It got drags there, and then nobody's happy at the end of the day. So this is what we have been also seeing in many countries, and I would also come back to you on that one regarding this feed-in tariff, and also this kind of incentives that the government will provide to attract private sector there. What I also found is that the technology is changing, the costs are going down. And then, for example, is PPA. We need let's say 25 years of PPA for any generation, for example, right? So then they will agree on a certain rate for today. But after a few years, then the cost of all those things goes so down, then it becomes such a huge burden for either to the distribution company or to the government to keep honoring those things there. On one hand, they have signed those PPAs, and then that was the kind of assurance given to the private sector so that they were able to mobilize this financing and so on. But then after a few years, things have changed so much that the other party is giving it a much cheaper price of that one, right? So how do we kind of balance this aspect of it? So that is also, that I always wonder, how do we address these things there? So any one of you would like to comment on these things there? Randy, you want to go first? Yeah, sure.
Yeah, very much so, because I think there's a really important topic to be discussed here. First of all, I noted down PPAs, which is really, really important. But if I first address the kind of the consideration of government saying, like, why do we need to pay these old PPAs that were so expensive? Now we can get cheaper power. I think that is a dangerous way of thinking about it, because the investors who invested before the price of the electricity or the solar panels or what have you not went down, they still had the costs that were reflected back then. That doesn't mean that they could get the cost that they necessarily have today, and the price necessarily wouldn't have gone down if you didn't get the economics of scale. So I think it's about kind of comparing apples and apples to bananas and bananas, right? Because discussing what like the technology can do today and comparing that to, I would have wanted that 10 years ago, but that's just not possible. We don't have time machines. So a little bit of realism here in that discussion from the government side, I think is advisable. But when we talk about PPAs, I also think there needs to be some education on maybe investor side and bank side, because historically, there's been a lot of these very fixed physical PPAs that are 25 years on thermal assets, and they are awesome. If you're an asset owner and you have those, that's great. But as the power system develops for more intermittent renewables or variable renewables, we need more flexibility. So we need to look at how PPAs remunerate the actual things that we need in the power system versus just having these traditional old types of PPAs. So looking into new ways of doing that is really important, because that also kind of secures the future of the power system. Because what we're seeing now, for example, in a lot of Asian countries, is that we have stranded assets on coal. So now we're looking at coal phase out, buying out all coal plants, potentially renegotiating, which is dangerous for the investment environment. Not saying it can't be done, but you need to be really, really careful on how you do it and the stakeholder engagement on how you do it, not to destroy investor confidence going forward. So that kind of thinking about new and innovative ways of compensating the assets that come in is really important as well. And one of the things, for example, that Marga talked about that I think is really important is that we're seeing smaller banks not, for example, willing to invest in energy efficiency incentive or projects because they're too small and they don't really understand the payback method that is from a reduced power bill. but they're still good projects, but there needs to be some capacity building in the financial sector as well to make sure that the financing and the risk is understood. Because when I started back in Europe 10 years ago, talking to institutional investors about buying big wind turbine parks, they thought basically they were buying a bond with a fixed return. But no, you suddenly have volume risk on the wind speeds. And that is a very, very different risk than the instruments that you historically have had. So understanding the risk and what type of risk you're taking on is really, really important, both from the government side, but certainly also on the private sector side. That's just my quick 2 cents.
Good. Sorry, I was on mute and then trying to unmute also. John and Marga, you want to comment on this? If you don't have it, it's also okay. But please go ahead, John, if you want to say something on this aspect.
Thanks a lot, John. Yes, I have just a couple of comments. So just on the banking side, I think that the financial sector and private sector investors are already under some considerable strains given recent developments, and also Basel IV requirements will place strains on the banking sector itself. So I think this sort of links back to the initial point that we had about the willingness to assume risk. I think there's a clear lack of information across the different returns that are available across different types of renewable energy projects, for example. And this would certainly help to encourage greater investment in light of credit constraints that may be in place today. As well as that, I would say that governments need to be really highlighting the need to diversify the energy supply network. As we've seen with recent developments, energy prices and commodity prices generally have soared rapidly, and this really underscores the need for a more diversified energy network, in particular through further development of renewable energy. I think that much more information on that would help to stimulate an impetus towards more investment in renewable energy for the purposes of diversifying the network and therefore reducing the costs across the board. So I think this general point can be made, and it should be voiced very clearly by government, and I think it would help to stimulate investment at a very basic level through improving information. That's all I would say on that for now. Thank you.
Yeah, thank you. Marga, you want to come in?
Yeah, maybe just a brief comment on investor education. I was talking to, let's say, like a solar developer in Indonesia yesterday, where they couldn't access local financing from the banks. But solar isn't new technology. It's been around in the in the neighborhood for some time now. And in terms of PPAs and things like that, these are well understood structures. But if you go to a more local financing kind of institution, it's just lack of familiarity with known kind of financing structures and known kind of risks. So I think there's really a need here as well to kind of, a more concerted push for more investor education, not just for the larger banks, but for the more local facilities. Especially, I guess I just want to make a comment around making sure your kind of tier B, your medium scale enterprises don't get left behind. And that's really for example, in the Philippines, where your CNI developers, it's the large companies, large conglomerates, getting the CNI contracts. But you have a lot of CNI developers who came in, or solar developers who came in over the last few years. But you're kind of tier B. And they're the ones who are, there's going to be let's say a consolidation, where else are they going to go? But these are the same people who are actually willing to look at your medium scale enterprises outside of the large cities. So if you want a more holistic kind of growth, for example, in the CNI sector, you can't forget the smaller players, and making sure that let's say local funding institutions are able to finance those projects as well.
Thank you, Marga. You wanted to say something, or are you done for your input? Okay, good. No, thank you. These are all, of course, we can keep on talking about this enabling environment. This is a kind of very complex topic. And then, of course, we'll not be able to finish it in go. But I think these are all very important points. And I think the important thing is to continue exploring ways and means of establishing that enabling environment where private sector can come in and take it forward. So now I'm also mindful of our limited remaining time we have. The next topic that I wanted to quickly touch upon is this financing itself. The problem I see is that the developers are looking for money, and then the investors are looking for projects. And they don't find each other so easily or so often. I work here in ADB, so of course, I'm on the public side of it. Of course, we support the government, but even our private sector department in ADB and also when I interact with other investors, they always say that, look, they're always scrambling for getting a good projects. They always are looking for projects. They want to finance this because they have their corporate targets, or government is pushing them to finance on this kind of aspect there. So they're always looking for projects. And then, but if you talk to the project developers, then you say, oh, I went there, they didn't give me, nobody's listening, or their terms and conditions are so difficult, so we'll not be able to meet. How do we manage this big gap in level of understanding, or level of kind of a trust for each other? So that's the question that I wanted to also get all of your thoughts as well. But there are also other things about this subsidy. I think, John, you mentioned about the subsidy for this fossil fuel. I think there's a lot of, now there's a kind of big debate going on to various countries in terms of how much that subsidy is just for this fossil fuel kind of a thing. But it has been, and it's a very sensitive topic also, because they don't want to touch that aspect so easily and so frequently as well. So that's also, if any of you would like to comment on that one, that will also be good there. But I think there are some countries have already taken a bold step and then trying to reduce that subsidy for fossil fuels, which is also a good part of there. The other aspect of is this concessional financing, the need, especially for this NDC aspect of it. Again, various donors have, created many funds where they put in their money, and then that, of course, they'll have to follow their processes of selection of projects, and then ensuring that the money is used for that intended purpose as well. I see again the money sometimes in many of these funds are keep on lying, or their processes are so cumbersome that it's very difficult to get things out. But they also have a kind of a responsibility to making sure that that funds are managed as well. So they cannot just keep on distributing just like that as well. So, but then we need to move faster in deploying these funds because of this climate change aspect as well. So, and also I think all of you mentioned about these local financial institutions. So I think, Marga, you took example of Indonesia, for example, and also in other places. So they are already investing a lot, but there is still a lot of room for changing their mindset, or giving them the comfort that it's okay for them to proceed, or coming up with some kind of risk mitigation facilities, so that they will be much more comfortable of investing that one there. So this is where support from the governments and also groups like ADB and others can also come in and give that comfort to them where possible there. So I would like to invite all three of you to comment on this aspect of it. Maybe this time, John, you would like to go first on some of these things, and then we'll go to Marga, and then with Randy. We'll make a little bit of change there. John, over to you.
Yes, thank you, John. So I think you've highlighted a number of important points there, and if I could comment on the issue of energy security. So you talked about the subsidy on fossil fuels, and clearly the shift to renewable energy is a much longer term undertaking. And the subsidy for fossil fuels is really highlighting that we still remain dependent on fossil fuels, and there still exists a need for a lot more work on this transition, energy transition, and shift towards more renewable forms of energy and diversifying the network and so on. So I think that, the factors that can contribute to that, we have already somewhat touched upon, such as infrastructure deficits that are in place to enable renewable energy to be carried out, power storage issues, for example, with some of the very important types of renewable energy, such as wind and solar. All of these factors need to be addressed at the technology development stage. And as we mentioned, that stage of development tends to be much more risky in nature. So in order to attract private investment to the much more risky stages of renewable energy adoption, it would be necessary to provide investors with sufficient amount of information on the topics that we've already discussed, particularly those related to regulation and climate policy. Private investors are not averse to taking risks. They take risks measured against returns, but there needs to be some information provided. We're not saying that private investors want to have zero risk. They will take risk once there's some information provided on the projected return. And at the moment, we do not have sufficient information on the projected return in terms of its magnitude, in terms of its duration, when it would be likely to materialize. And until we really have greater insights on those factors, we will continue to have a huge deficit in our private investment needs. Thank you.
Thank you, John. Marga?
Yeah, I think kind of just taking off from where John was, but I think like some of the things that we could potentially look at, or at least in the private sector, is potentially looking at more kind of blended finance facilities or new, I guess maybe different kind of layers of financing, where, for example, I've spoken to other people looking at like green bonds, but investors are not willing to take like 100% of that like project risk. So maybe potentially looking at layers of like mezzanine debt or like first loss capital to kind of go into the kind of de-risking some of these projects, and like your investors who are co-investing with, let's say, people who are willing to take subordinate like risk or first loss kind of risk or guarantees kind of structures will help like de-risk some of these projects. And you kind of have, if you go alongside like your local banking institutions, they kind of get a taste of these projects and they're able to do it themselves. So it's kind of opening the door for some of these like private institutions who are not familiar with some of these sectors, but at least like give them like risk sharing kind of structures with financiers who are willing to take on a little more risk. So maybe like blended finance facilities, guarantees, that we don't really see a lot of yet in Asia.
Thank you, Marga. Randy, please.
Yes, if I come in on both actually something John and Marga said, if first we talk about blended finance, I also want to kind of talk a little bit about blended ownership. Because one of the ways maybe to start to get some private finance into some of the sectors where they're not usually that comfortable could be public-private partnerships, especially in some of the countries where we see a very, very dominant incumbent utility, for example. Having the government mandate that they have a larger portfolio of public-private partnerships would give the private sector some experience in a country or in a market that may have really, really high barriers to entry, with some of the security that they're in it with kind of the utility. So there is some kind of push to move it forward. And in some countries, you'll always also see that the incumbent utility can be a real barrier to negotiating PPAs or something like that. So if they're in it together, maybe there's a different kind of learning and push to move the projects forward. So that was just my first point. And then to something John said, he said there's low visibility in projected returns, which I agree with, but there's also sometimes low visibility in the projected risks. And this means that if you're a private company and you have your balance sheet and you have to have a risk-weighted balance sheet, if you don't know the risk, then you're going to assign a really, really high risk to it. And it's going to take up a really, really big chunk of that kind of risk, that capital that's available to take risk, meaning that you can invest less. So in order to kind of unlock private finance, you need to make sure that they understand this type of risk so that they can assign it better to their balance sheets. Then lastly, the point that you made, Joanne, on matching funders and investors, I think one of the things I want to highlight that we're doing in the GGI group under COP is there's a finance group under this umbrella that made principles to unlocking climate finance for grids. And I think, for example, educating governments or private sector on how to use these principles to make sure that cases or like business cases coming to the FDIs are more streamlined and easier to evaluate across the board and across different type of asset classes is really, really important. Because, for example, if you're seeking climate finance for grids, that's a tricky one because a grid is not necessarily green. It can be, you can transport any type of electricity generated over a grid, but you need to demonstrate some kind of progression as to why this grid is enabling more renewables or, plans and policies. And having these types of frameworks created at like the multilateral institutional level and disseminated down through governments and private investors may actually enable a more common language that will facilitate a smoother dialogue between funders and investors. Thank you.
Good. Thank you. I think, again, this topic of financing is also so complex as well. But no, I think all of you made good points there in terms of looking at new ways and means of identifying risks and taking the risks, and also also the returns, security, and also this blended finance related thing that all of you mentioned, which is very good there. I'm also conscious of our time. But there are several things that I still wanted to touch upon, and then I have also seen a lot of questions for all three of you that in front of me from the participants. So I will also pass on to you as we progress. And some of these things I have already blended in my questions to you in earlier also. Two things that I wanted to raise it here. One is this, when we talk about this financing, bringing private sector and so on, we always talk about on the mitigation side of it, right? So it's basically just easier to understand and so on. But adaptation is so important and crucial as well. So then also, can we bring in private sector for adaptation related work? So I think there are some good examples available in various parts of the world also. And then Marga, some of the projects that you mentioned has also, kind of a strong adaptation angle into it as well. But I think, increasing investment in the adaptation is very important and critical, as we all know. So I think it'll be good to get your comments on that aspect of it. And then attached to that one is about this partnership. Randy, you also mentioned about this, some kind of public-private partnership, but at the same time, partnership between various governments, multilateral agencies, bilateral agencies, private sector, financial institutions, NGOs, civil society organization, also research think tanks as well. So I think there's a lot of a lot of areas that to be covered, and then not one organization or one entity can take care of it. So I think, for example, you and SCAP, Randy, you mentioned that, there's some of the work that you are doing it together to bring in various groups together as well. From ADB side also, we are doing it to some extent in some areas, and some other agencies are also doing it like this. Because unless and until we all work together, we'll not be able to meet these climate targets that we have it there. So I think further enhancing this partnership of various groups becomes very, very important, even more important now than it was before there. So again, mitigation and also adaptation kind of angle, and also this partnership thing, if you could mention, that will be helpful. So this time let's start with Marga, and then we'll go back to Randy and also John. So we'll take that turn. So over to you, Marga.
Yeah, I think on the adaptation side, I think one of the big topics that we look at Sunfunder is climate smart food systems. And it doesn't get that much attention, but I think it's going to be an increasingly important topic. And like, how do you actually finance like green kind of supply chains? And like, I mean, we're starting with things like solar water pumps, like solar for cold storage. We're looking at things like greenhouses and things like that. But I think it's really, if you look at a mini grid side, it's not just agriculture. We're also looking at things like water supply, like access to water, like using your mini grids for purification, desalination, and things like that. So it's really kind of breaking down these silos between the different sectors. Like if you look at the way people think about topics, agriculture is one topic, energy is one topic, water is another topic, but it's all interlinked, and it needs to be increasingly, when you think about like finance and things like, it needs to be increasingly interdisciplinary. So if I think about even things like energy efficiency, like how do we reduce, like let's say like air conditioning, things like that on the cooling side, where it needs to be, yeah, just having more of these like interdisciplinary approaches. Like in water, when you think about water contracts, they look very similar to like your ESCO contracts for energy efficiency. So it could actually be financed like an energy project. So like kind of using lessons from the different sectors and applying them, I think is important. And we shouldn't really be like all of us here work in the energy sector, but like we shouldn't be siloing ourselves from like some of these very interlinked sectors that, yeah, like agriculture and water. And yeah, like using kind of the same models, like for like solar home systems, and like your receivables-based financing for solar home systems in Africa, we've used that like for the last 10 years, but can we apply that to productive end uses and things like that on the agriculture side? And it needs to be increasingly used there. So it's taking lessons from other sectors and using them here. Yeah.
If I come in terms of adaptation, I also want to talk about, because UNSCAP, obviously we work across the Asia Pacific region, and in the spirit of leaving no one behind, I think it's also important to talk about some of the Pacific Islands, for example, and some of the debt crisis that they're in. We're seeing more talk about debt for climate swaps, for example. And I think those types are really important, also talking about adaptation. And a lot of the debt for climate swaps I've seen that are really quite substantive. They've talked about, nature conservation, which is extremely important. I'm not kind of negating that. But I wonder if there would be a way to incorporate an energy component in terms of sustainable energy and building back more resilient, adapting the energy system when you're doing debt for climate swaps. Because when you're looking at these types of sectors, because they have a guaranteed revenue from rate users, you can apply less of a grant element and more of a concessional finance element to these debt for climate swaps, which might actually make them bigger and kind of more inclusive. So that's just the short comment I wanted to do on that one. And then we're talking about partnerships and support across the different countries. Obviously, this is something that UNSCAP is extremely involved in. And we're seeing the donor space is actually quite large from other governments, from philanthropy, and what have you not. And I think it's really, really important to say there's enough work to go around. But making sure that we coordinate that work is so important, because one of the things I think that can really confuse governments that lack capacity is if different institutions come in and do different modeling and analysis with different types of assumptions. and those aren't made clear, and then they have all these different scenarios on how they could mitigate or reach their NDCs, but they don't really know which one to trust. So I think it's also up to us in the donor community to be much more aligned and really try to support each other and reinforce each other's messages, because basically we're all working towards the same goal. We're all working towards sustainable development in the Asia Pacific context. And, you know, somebody who's really specialized, let's say there's a consortium of the TSOs, which I know there are, they're really specialized in going in and helping the system operators. Well, then maybe let them do that and let's support whatever they need around that. For example, on government level, the people who have really good contacts into the government, ADB, who's in finance, has a really good understanding of how, you know, you structure debt products that maybe I and you and SCAP don't have the same understanding of. So kind of going hand in hand and showing these very holistic ways of tackling the issues, from, you know, high depth, from lock-in stranded assets, from system flexibility, and in general, you know, economic growth, because in the end, one of the things that will really get governments to listen and open up also to private finance is showing how this benefits the economy of the different countries. So that would be my comment on that. Thank you.
John, anything from your side, please?
Yes, thanks. I'll just have a brief comment. I think that, you know, climate adaptation is obviously also important to consider. But in order to stimulate private sector involvement, whether it be mitigation or adaptation, it goes back to the same issues that we have been discussing throughout this session, namely understanding the risk relative to the return. I think this is the case whether we talk about any type of encouragement on private sector involvement. I think that one important factor which we sort of touched upon was the issue of blended finance, and this can be a crucial aspect for climate adaptation, in particular in terms of achieving scale. So achieving scale across private sector investments across different projects through assuming the bulk of the risk for early stage renewable energy type of large scale projects. I think this would be an important avenue which can be looked into further.
I just wanted to add in this, like, adaptation. I think the other source of financing we haven't really thought about here is like carbon financing, and I think that's increasingly being used in things like forestry projects or like blue economy, where it's a new source of financing. Like, we're increasingly seeing projects like, let's say, like biogas biomass plantations, like getting like, let's say, forestry credits and things like that, and getting pre-financing. So I think there are new kind of business models coming up around like carbon financing, and just the importance, I guess, of having more price transparency like moving forward. But I think it's a increasingly kind of viable financial solution for these harder to finance topics, like from a more traditional financing standpoint.
Thank you. I think we are kind of coming to a close for our session. I mean, of course, we'd love to keep talking, but before I wrap it up, there are certain questions that we have not yet covered, and then I will pass on to three of you, and then maybe you can use that as your final comments as well. And then we can close this session. So let me start with Marga, because there are some questions to you related to, you know, your various programs or initiatives in the various countries, and if somebody has to approach you for financing or anything, how would they do it? Have you done any energy plus solar plus battery storage kind of a projects? Do you have any experience on that one, or any other broader things of bringing their partnership together, and how can you help others, and what kind of support that you need from others? If you can take a minute or so to summarize this thing, and wrap up.
Yeah, I guess I can just give like a shameless plug for Sun Funder. So we provide loans anywhere between $1 to $25 million. We have two funds that we can use. So we have one called the Solar Energy Transformation Fund. Ticket sizes between 1 to 8 million. And we have an upcoming fund called our Gigaton Fund. It's a $500 million fund. We expect that to come online later this year. And through that, we'll be able to look at things beyond solar, including energy efficiency, mobility, storage. And and more like your agri-solar productive end uses. And in terms of like types of financing, it could be working capital, project financing, inventory financing, receivables financing. And I think it's just being very, very bespoke and willing to take risks. We're not a traditional funder. And as a blended fund manager, I mean, we're set up to take these risks and be kind of the first mover in some of these markets so that we can open it up to other traditional funders. So yeah, if you need to reach me, I'll drop my email in the chat box. And yeah, just message me there directly.
Okay, thank you, Marga. So now let me move on to Randy. One of the questions that I received here, which we probably haven't talked about, is can we encourage our traditional IPPs who are into, let's say, non-clean energy? How can we move them towards, or how can we attract them for the clean energy or renewable side of it? And then any other broader comments that you would like to make as your closing remarks?
Yeah, so I'll just make a short closing remark on that. I think it's really important to note that we need everyone in the power system to work together. And the traditional asset owners, well, you have a role in the future as well, because flexibility is needed. The sun doesn't always shine, the wind doesn't always blow, so on. And we need, until we've kind of figured out a very, very, very long-term plan, to kind of do everything in a renewable fashion, we still need these assets. So I think it's all about incentives. We're human beings. We do things according to incentives, and figuring out how, first of all, these traditional asset owners can potentially pivot their business to look a little bit more sustainable. For example, in co-firing of biomass or what have you not, hydrogen in the future. That's really important. But also just saying, like, your traditional baseload operational pattern maybe not be the best one suited for the next, let's say, 10, 15 years. But there's a way to create incentives where you're still compensated for the value you produce to the system, and making sure that's very clear. It's not just like a black and white thing where, you know, fossils bad, renewables good. You know, we know where we want to move. But there's a bridge, and we need to do this all in a sustainable manner, both financially, energy security-wise, and energy access-wise. And we need everybody to work together. So I definitely think there is a way to have the traditional asset owners contribute to the clean energy transitions. Thank you.
Thank you. Now, John, there's one question related to this feed-in tariff. If it is still how do you say, relevant in the Asian context, or shall we move away from that feed-in tariff kind of thing and let the market decide what and how it can be done? And any other final comments that you may have, John? Over to you.
Okay, thank you very much. Yeah, I'll just make a brief comment. I think that initial capital expenditure costs are very high for certain types of renewable energy, and certainly at early stages of renewable energy adoption, technology development stage, for example, feed-in tariffs can have very important benefits for encouraging private sector investment. So I think that certainly our analysis indicates that feed-in tariffs remain important for attracting private sector investment, and particularly for renewable energy technologies that might be at the more early stages of development. That's what I would say on that.
Good. Thank you. So we have used 2 more minutes than what was allocated to us. Now I think we need to close this session already. Now I would really like to thank all 3 of you for your remarks and presentation and sharing your thoughts as well. And then, of course, these topics are so complex, and then it's not so easy answer to all of these things. But I think opportunity like this helps us bring out some of our thoughts and ideas and experiences, which will also be helpful for moving this forward. And to our participants, I would really like to thank you for joining this session also, and also raising important questions. I hope that I have covered most of your questions to the panels, but if there's anything remaining, I'm sorry for that, not been able to manage within this time, but I feel that broadly we are able to cover those aspects of it. Again, this is a dialogue that should continue over time. And then as we all know, we all need to work together in this space, and then we should continue working together as well. So with this, let me close this session. Thank you once again to everybody, and then please continue enjoying our SF other sessions as well. And you take care. Thank you. Bye-bye.
Thank you.
Thank you. Bye-bye.